there, and that's what Mr. Ted has found out. All right, Lauren, great stuff. Thank you. Let's check the markets and bring in our market guy, David Stryzewski. David, look, all right, we're modestly higher this morning. The numbers, though, for this year are pretty ugly. The NASDAQ down nearly 34%, the Dow off 8.5%, which I guess in consideration is not as bad. S&P down nearly 20%. As we look ahead to 2023, do we take another leg lower? I mean, do we hit new lows?
Good morning, Ashley. I do believe that we're going to hit new lows in 2023. 65% of Bloomberg respondents believe that we are going into a recession. I'll just say this. Visa and Fannie Mae were in that group. 83 and 85% belief of a recession next year. So the market is looking at challenges as we move forward into the future. Ultimately, I think that we're looking at what I'm calling the Federal Reserve bubble. What do I mean by that? I mean that the Federal Reserve has increased so quickly over these last 12 months that it leaves us in a very difficult place as the American consumer. We're likely to see stock markets decline, bond markets decline, the housing market, we're seeing the air come out of right now. But here's another big one. Corporations. Corporations today have been borrowing at record low interest rates, have been buying these buildings, and I'm seeing a bubble in all of this right now. And so, I hope that everything goes up. I vote that the market turns out amazing as the year turns around and the Fed potentially accommodates. But ultimately, I think that we need to be very defensive, and the average American needs to wake up to this fact, because I don't know that they've necessarily been prepared by Washington, D.C., the Biden administration, and Jerome Powell.
Given all of those headwinds, David, and you just said it right there, you got to be defensive. I mean, what are some of the best plays for an investor right now?
Well, I look at the world in three different metrics: cash assets, protected assets, and risk assets. And so as a retirement planner, the goal is to have the right diversified portfolio. So having more cash today is very intelligent. Think treasuries. The protected assets are where we really need to be paying attention, and that ultimately talks about bonds. And so if we see interest rates increase, well, we know that bonds lose money. Just look at your portfolios this year. But here's the other one. If corporations are having to have challenges with higher interest rates paid and new borrowing with debt, I think that there could be defaults. In fact, I'm really concerned as we look forward that there's a lot of debt and junk out there. Junk bonds have been borrowing at 4% in the past, and they were not as creditworthy. How do you keep everything together in this economy with new interest rates signaling, and ultimately, where do we go from here? So I don't think that we're seeing a tremendous opportunity. I don't think that we're looking at big upsides here in the next few days or something. So people need to be cautious about this, and then also reevaluating how they're investing. So be focused, but be tactical in how you're allocating things. Right. And my last point here, Ashley, is that in that protected asset space, I think that there's an asset class that people are not paying a lot of attention to. That's called a growth-oriented fixed index annuity. There's never been a better time to own one. People should look at them. They give you none of the downside, but a reasonable rate of return on the upside. Think 10-year treasuries plus 2 as an example. So that's a great alternative.
Very good, David. Thank you so much.